Well, good evening. Welcome to this live stream on the 4th of March, 2025. It's Martin North here from Digital Finance Analytics. Great to have you on the stream this evening. Thank you very much for taking some of your Tuesday evening out to share it with us. Damien's teed up ready to come in. Just before I bring him in, I should remind you, as I always do, that we don't provide specific financial or legal or property advice. The general conversation only. We moderate the chat, but feel free to throw your comments and questions and suggestions in as we go. I won't necessarily follow all of the chat because there's so much that goes on. But if you'd like to ask a question of Damien or myself, if you use @Walk the World, that then gets it into my queue, so I make sure I don't lose it. And I've enabled Super Chat, which means that you can make a contribution to what we do here, or indeed lift your question to the top of the list. And always support is greatly appreciated because, well, we don't do this for profit. We do this because we think there's a really important conversation to be had, and I think more so than ever at the moment. So very important that we keep going. And all of those who support us via Patreon or via the other mechanisms and taking adverts as we go, it all helps to keep the show on the road. Right, let me bring Damien straight in because there's so much to talk about today. Damien, welcome. Having fun yet?
Yes, there is a lot going on, Martin. I don't think we haven't got time to talk about everything because I think by the time we get through one, I'm sure something will have been tweeted at us and yeah, we'll have 3 brand new things to talk about.
But last month I talked about signal and noise and trying to discriminate, what was actually influential in terms of making strategic decisions about where to invest and how to invest, and what was just chatter in the background. And to my mind, the tariff thing has moved dramatically from noise to signal. I think the Ukraine situation has moved in that same direction, and even the question of the relationship between Europe and the US. These are all things, to my mind, which now are moving into the area of actually there are important questions to be thought about from an investment decision because of it. And in a complex environment, it's actually even more complex to try and work out how all these things interact.
Yeah, absolutely. And look, we flipped quite recently to selling down a lot of a lot of the gains we've made from this run, and building up this sort of reserve of cash with this view as well that I think Trump certainly thrives on a reasonable amount of chaos and loves to have 20 different things that are sort of all out there in the media. I think the issue we have at the moment is he's starting to mess around with some of the delicate components of the world economic system. And I think there was certainly a number of people last time around who would basically give him kept him sort of away from the more dangerous parts. And whereas I don't think he has that the same amount of, I guess, guardrails this time. And I think there was a lot of people expecting that Besant would play a lot of that role, and ourselves included. I think what's being shown now is there's enough variability that I do think he's going to be affecting certainly, 1 in 5 employees in the US works for the US government and has just got a letter basically saying, explain your job. And so you might not be losing your job, but you probably know people who are, and you probably are less certain of your own position than what you were. And so, and everyone knows, that's 1 in 5. Everyone's going to have somebody who they know in that position. You've got companies then facing tariffs are on, tariffs are off, and it looks like they're back on again. And I think the first round of tariffs was, I think people treated that as the first sort of go at Canada and Mexico, people sort of treated that as it's the art of the deal. He's just taking an extreme position and get negotiated back. I think it seems to be a little concerning that it's come back so strong without a lot of actual. It looks like they're going on at the moment. They could change in the next 5 minutes, But I think there's certainly enough concerns there that, that it's going to start damaging companies as well in terms of their confidence. And we saw some pretty decent falls in terms of consumer confidence during the I think it was probably earlier on last week. And I think there's that, that's once you start getting to that point, this can become a bit self-perpetuating. And even if he decides, I'm not going to put those tariffs on, and I'm going to start pulling out of, I'm going to start trying to be a bit nicer to, say, some of the employees in the public service, or try and give people some hope to it. I think he's done enough damage already that that'll take a while to get back out of, in terms of once you've made those types of statements.
Yes, and I think last month we touched briefly on the idea that Trump is very much for America first. And, so when you understand his decision-making process, it's all about trying to put America at the center of the map, the rest of the world very much around the peripheral. And, what he's thinking about is only quite a narrow base, but an important base for his base. But it is interesting, this tariff question, of course, there was a lot of speculation amongst the talking heads up till quite recently, that this was just playing games. It was actually just positioning to cajole people to do things. But it's certainly moved on from beyond that now. And in fact, there was... I
feel like the last time I was going to come on, Martin, I was starting to prepare for the tariffs the weekend before. And then by the time we got on Tuesday, that he'd flipped his position. Yeah. And so it was like, I don't think everything's all right again. So, there is a chance that happens, but it seems less likely this time around.
Yeah, exactly. And in fact, Moody's put a quite interesting piece of research together. This was actually quoted in the Wall Street Journal, that made the point was that the tariffs doesn't necessarily translate to the same price lifts. It depends on, the route that you go through and how it all flows through. But, if you look at, for example, US manufacturing, intermediate components, there can be quite significant and profound impacts. So it's a question of how this translates. But to my mind, I think you touched on a very important point, consumer confidence. And in fact, it was the Michigan Consumer Confidence Survey that first detected this significant swing in negative consumer confidence and higher levels of inflation expectations. And it was interesting that the talking heads said, well, you can't believe that one because it's quite a small survey, and it'll be one side of politics rather than the other side of politics. So a lot of people, I think, said, no. But then we had the bigger survey this last week that showed precisely the same trend, that actually consumers were becoming significantly concerned. And we also saw inflation expectations rising quite fast. We then had a couple of business surveys coming out of the US that also started to talk about firms holding off from investment because of uncertainty, because, firms don't like uncertainty. That's understandable. And so some of those things are now beginning to play out. And what I thought was quite interesting, that at the end of last week and at the beginning of this week so far, people were starting to talk quite concerningly about, well, maybe the net impact of all this stuff is quite negative on the US economy. Maybe we could see stagflation in the US. Maybe, what we expected to happen is not going to happen. And that puts a question mark over some of the extended valuations that we still have in a number of sectors. The other interesting factor is if you look at the recent movements in markets and compare the performance of the US markets with the European markets, actually European markets over the last couple of months have done quite a lot better than US markets, which is quite interesting. So that, there's a whole lot of question marks about the international order, the question of where capital flows will go to. Berkshire Hathaway, disclosed quite recently they're sitting on a huge pile of cash at the moment because they're just going to wait and see how some of these things play out. And you've said that you've sort of done a little bit of protection activity to protect the gains that were made. It feels to me that we're actually in quite a new world and quite an uncomfortable world, and the level of uncertainty, and therefore from an investment perspective, because if you are an investor, of course, you can sit on the sidelines for a certain limited amount of time, but ultimately investing means engaging with the market one way or the other.
Yeah, that's right. And so, certainly if you're talking long-term investments as well, so for people's superannuation, if you're looking at savings that you're doing with sort of a 5 to 20 year horizon or whatever it is in terms of the money you're saving, there's a certain element of saying, well, look, if you're going to jump in and jump out at every gust of wind, it can be problematic just because you're raising these capital gains. And so, if you sit in something and it goes from 100 and up to 200 and back down to 150 and then up to 300 and you don't sell it, you're like, well, I haven't worried it. But if you manage to time it perfectly and you went, 100 to 200 and I've sold it, now I've got $100 of capital gains. Maybe it's only 50% of that, but I've got to give back $50. So even if the market falls, back to 150, I'm paying interest on some of those gains. Sorry, paying tax on those gains. And so then when it rises again, I might actually not have as much money invested from that perspective. And so there's also two things you've got to get right when you're getting out. You got to get the decision to get out right, and you've got to get the decision to get back in right. Because if you're too late or too early on getting back in, then you might miss some of those issues as well. So for people who have that longer term time frame, and most of our funds, that's what we're investing on that basis. Is to us, it's about leaning in and out of the cycle. It's not about saying, right, I'm worried about the market falling. I'm going to zero, and then I'm going to turn back around when I'm happy and go back to 100. It's about saying, let's tilt out of that, come back a little bit more, and flip back in. And then, but there's also as well for some people who are, I guess, particularly if you're the view that look, the investing part, I really don't want to know about. It's my superannuation. I just want to forget about it. Then, and you've got a long time frame, is then maybe just ignore everything and get your asset allocation right in terms of your risk ratings. How much equity or how much stocks do I want versus how much bonds, and then just ignore it and ride the cycle out. My preference, I think, is to tilt in and tilt out. But I guess I just want to make sure people aren't doing 0 to 100 every time you get concerned about things, and particularly about things that Trump says, because he can flip around, the following day. So,
yeah, and what I would say is that sometimes the coverage that the media throw up, I think, panic people into doing more than they probably should. And funny that
everything's a little bit bad doesn't sell that many newspapers, whereas everything's the worst ever sells obviously a lot more newsletters and gets clicks. Yeah.
And I remember a few years ago now, I was on Radio Sydney when there was quite a significant correction underway, and the announcer was trying to get me to say that people should be, selling everything. And I said, no, you've got to understand, cycles come, cycles go, prices go up, prices go down. The traditional view, and I think the right view, is ultimately it's up to the right, but not in a straight line. And that's just worth thinking about. And that's, of course, one interesting reason why sometimes, just tracking the index is perhaps, a little bit less worrying for some. But the risk is that you actually end up then being pulled down by the sectors that actually are underperforming relative to the ones that are overperforming. So there's no simple correlation nor answer.
That's right. It needs to sit with what you feel comfortable with, and how interested you are. And that's very much what we're trying to do, is give people this idea that we either run these portfolios or we give you just sort of a passive portfolio, and then you can put your own tilts and screens on that. And so, we've sort of tilted ourselves into, we've been in European and Japanese stocks as well, in particular for, I don't know, certainly 6 to 12 months now. And in the latest sort of batch, as we were selling down overall, we were flipping out of some US stocks, particularly discretionary US stocks, and flipping more into European stocks as well there. So I certainly agree with those sort of broader sentiments in terms of sectors. What was the other thing I was going to
I was going to ask you a question, Damien, talk about sectors, because of course it's the defence sector that's really had a massive leg up. And this is the chart for BAE Systems, which is up significantly. And there's a really interesting contention that I personally feel, because I actually don't believe in investing in defence sector as a sector, because I don't think morally it's a good thing to do. But when you look at the upside, there will be people who will say, well, actually, in the light of what we're now seeing, the remilitarization of Europe, the contentions that we're seeing there, in the short term at least, it looks as though the defence sector could be quite a strong sector relative to some others.
Well, and I'm going to start. I'll unpack that in a whole bunch of ones. I'm actually going to start by saying you're confirming some of my bias is though. Sorry, I guess some of the data we see within ours. So one of the things we get within our sectors is within our portfolios is you can do exactly that. You can cut out the defence sector, and we find that older investors are much more likely to do that than younger investors. So younger investors are much more likely to cut out, say, carbon or climate change type factors, or animal testing, whereas older investors is often make up that much more likely to cut war out of their portfolio. And then I think we've certainly seen a switch as well post Ukraine of people who are like, well, okay, I probably don't want these war ones, but actually somebody needs to sell the arms that's going to Ukraine. And so, yeah, we've certainly noticed that. What you would see in those charts as well, if you flipped it around and looked at some of the US guys, is it's actually been the opposite. So they've actually seen this in the recent week or two, they've seen a bit of a tumble in some of the share prices. And this is this whole idea that, okay, is the US going to stop putting into the Ukraine, stop supplying weapons to the Ukraine, and are they going to stop cut back on some of their spending? Now Trump has suggested that maybe he comes to an agreement with China and Russia, and everyone halves their defense budgets. Well, yeah, look, you can't comment on every kite that he flies, but I feel that seems unlikely, and it certainly seems unlikely that. I guess I can see Russia and China certainly agreeing to that. I can't see them doing it, but I can see them agreeing to it. I don't know whether the Trump would then cut his budget by that much, but who knows? But I think it's certainly a sign, within Europe is, look, guys, you just got to start producing this stuff yourself. And we do see a number of signs coming out of Germany in terms of the spending there, and that was actually, we've been sort of lifting our weights to German stocks since the election around that idea that. There's the government, the incoming government. Well, it seems like the incoming government. I don't think he's completely got 28%, and he's got a few supporters that'll bring him up to a level he can govern. But it seems like they really are looking at fiscal spending. They're looking at whether they can take some of this defence spending and put it off balance sheet, so to speak, so that they can actually spend above some of the limits they're talking about. I do think there's it does look like there's a reasonable scope for Europe to increase its amount of spending. And interestingly, Europe, when you look at their armed forces across Europe, there's more people. They actually have a bigger army than when you combine, all the different groups within that than what the US does. But what the US does is it's very good in a bunch of areas that a lot of others aren't. And so that's the interesting part in terms of spending is. There's nobody else makes aircraft carriers really, and there's certain weapons that they have that they just can't. Not that Ukraine needs aircraft carriers, but there's certainly certain weapons that the US makes that sort of just aren't accessible from some of these European countries, and so there's elements of it where it's like, yes, these guys can produce the same types of things as the US. They just need to ramp up their spending, and there's other parts where actually no, they can't. Are they going to need to start developing these, outside the US? And do you see that sort of fracturing in that? And that's where I think where a lot of that, a lot of that spending is coming from.
Yeah, very interesting. And in an uncertain world, of course, the question is, how do you deal with those uncertainties? And interestingly, Father Burning asked. What happens to markets in the time of world war, as in Europe, Asia, and allies all in? Well, there's a couple of things. We seem to, obviously, uncertainty rises. Inflation tends to rise in those situations. If you look carefully, though, actually wars aren't that bad for stock markets, are they?
Some companies do really well out of it. And I think there's the government's obviously out there spending, and that tends to end up in the hands of corporates. And there'll be sort of wartime driven things, and there will probably rationing in certain areas, but companies do tend to do quite well in those times of war. And I guess there's noticed a lot of things, a few of those comments just flipping up about Australia versus Ukraine. The interesting thing for the Australian defence side is most of the stuff we need is the stuff that America makes. So, we're on an island, we need ships. We're on an island, we need aircraft. Like, we're not the same. Whereas, so say in the Ukraine or some of the, I guess, eastern parts of Europe, you don't need lots of air carriers and things like that, and ships to get you to where the front is, because you're already there. You don't need to. Your troops are, they need to walk outside and they're at the front. Whereas, there's other countries like the US or Australia or whatever, where a lot of it's like, we need to project force over long distances. And so, there's sort of Australia's, whereas I think there's parts of Europe you can look at, and particularly the Ukraine, where you can go, yes, they can actually produce a lot of what they need, either from Europe or internally, and there's only a few parts they need. Australia is very much dependent upon the stuff we want and need on the US.
Yeah, and just on the local defence issue in Australia, this was quite an interesting little slide here, right? So this is actually from China tracking the ships going around Australia.
Oh, right. Yes.
And Fred Paul said, if you live on the Australian coastline, do your bit for defence by keeping an eye out for Chinese naval ships. Call Defence Minister Richard Marles. My point is that the size of the Australian continent and the massive amount of stuff that would be required to do that suggests that the ability to be able to actually effectively, quote, defend Australia is actually relatively difficult to do. And of course, a lot of the defence spending is, as you said, to project out from Australia, particularly thinking about some of the Asian discussions. And I had Robbie Barwick on last week, who made the point that Australia and other Western allies have been effectively flying and taking ships around some of the areas up in the Pacific around China, and doing rather similar things to now what China's doing down in Australia. So it's a two-way street, really.
Well, and what's interesting is, I think for me is this is a test of how close is Trump going to support in terms of Australia. I think it certainly looked that, if we went back 3 or 4 years ago, and I think you would assume that the US would be very close to Australia, and AUKUS was sort of like set up for exactly this type of thing, to project power back towards China. And I think China's basically testing the boundaries of those and seeing how close things are. And so I think that's so for Australia, that's saying, yes, we're going to spend more on well, you think that this will be a thing to say, we're going to spend more on defense, and that extends right throughout Europe in very much the same way.
Yeah, and one would suspect that the upcoming election, which of course is due by May sometime, will have an element around the cost of living, because of course that's still a big issue. But more and more, I suspect the defence conversation will also be there as part of the policy. And in fact, of course, Dutton announced a policy, although whether it was costed is an interesting question, for more aircraft. So we do seem to be living in rather difficult and uncertain times. Interesting backcloth for an election. I guess the other question in all of this, though, and China's a really interesting angle to explore, because, of course, we've got this very strong trade relationship with China, even now. China, of course, is now retaliating with tariffs back to the US. Their economy is still looking relatively underwater from a growth perspective relative to where they were. Obviously, still better than many other economies, actually. But the impact potentially on the Australian economy because of what is going on with China seems to me quite an important factor to take account of when you think about comparing Australia versus other investment perspectives. But there's another issue, of course, the Taiwan connection too, because I suspect that the Chinese will be watching to see how America is handling the Ukraine situation now, and to what extent, are you going to leave people on their own rather than help them out? And what does that say for Taiwan?
Yes. Okay. So
Sorry, I'm throwing a lot of questions together.
Yeah, that's right. Let me see where we're going to start. I'm just trying to think where we're going to start on this one, because and there's a bunch of other ones we haven't really answered from some of those other ones where we started on cost of living and things like that as well.
Yeah.
Okay, so let's talk China in terms of tariffs first, because I think there's I do think that's going to hurt the Chinese economy significantly. What is the interesting part is, as China's been going, there's always been this theme coming out, and I've spoken about this plenty of times here, that all the resource bulls are always like, oh, they're going to turn the housing market back on, and that's where they're going to throw these. They haven't to date, and I think they're certainly where they seem to be throwing money at the moment is places like electric vehicles, and a lot of the solar and wind power and energy, and like there's this thing about and chips as well. They really want to, and you've seen this sort of some stuff from DeepSeek. They're really trying to bring themselves up that value chain. And so the question now is saying, well, tariffs come on, growth gets hit again. Do they now turn back to that property lever, or do they decide, no, actually that's done with, we're finished with that one. We really do need to lift up that chain. I think it's the second. If they do turn the property lever back on again, then it's all systems go for resource companies. But I don't think that is going to be the case. And I think that they're looking upon the things that Trump's doing and saying, well, they need to diversify away from what America provides, and the housing market. They know they can produce the housing market themselves. They don't need America for that. And so I do think that's poor for Australia. The other thing Australia really hasn't done, well, certainly not well, is articulate where do we stand in this whole tariffs, plan and everything. I think they're sort of trying to play a small target. I think so if we don't say too much, then hopefully, and we're obviously a net importer from the US, probably one of the bigger ones, I think, in terms of imports versus exports, and so I think they're hoping we slip aside, but that sort of sidesteps that issue about saying, okay, China's trying to get a tariff thrown on them. They're going to try to export that somewhere else in the world. Yes. And that's Europe sort of already talking about throwing up some tariffs as well, and trying to protect particularly their own car industry or car industries. And so I do think there's an element where China's going to be going, right, where can we dump as many goods cheaply as what we can? And Europe's sort of saying, well, maybe we'll let you in some areas, but we're going to shove up some of our own barriers. The US is obviously not going to want them, and they're trying to work out how they can stop them from coming through second parts. Australia is probably going to get flooded by cheap Chinese everything. Is that what we want? Are we happy for more industries to shut down and use whatever it is that China's got excesses of? It's not clear to me what either party's policy is on that, and potentially, hopefully somebody in there is not thinking about it. But I feel as if given the cost of living issues, they're sort of like, oh well, let's just ignore that, and that might be, we'll treat that as a win for Australia. But it does make those structural issues that when we let the car industry shut down in 2000. 2008, when just before the financial crisis, it didn't come back. Like it's, yes, the Aussie dollar was, when the Aussie dollar was 60 something cents, they were making lots of money. When it was $1.10 or whatever it hit, they were losing money. And so when they shut down, the fact that the Aussie dollar came back to the prior levels, they didn't all of a sudden start back up again. Those things take a long, long time to make those decisions. And that's the part I worry about in Australia is, it might look good for our inflation rate for a few years, but if we're just going to if that's at the expense of just hollowing out our manufacturing sector even more, and potentially some of the services sectors or whatever else you can get in there, then that's where maybe Australia should be putting some tariffs on to protect, or at least working out what the best way to protect some industries, in that you don't want to have an economy that is wholly reliant upon other countries in a splintering world. And, I think there's certainly parts of it where, I think our strategic reserve sits right in the middle of the US. and a strategic oil reserve. Sorry, we've managed to get a part of the US one. It's not really it's not really a useful place. No. Literally on the other side of the planet, right in the middle, away from not even on a water anywhere. So exactly. I think there's I'd like to think we could be a little bit more forward thinking about what we're producing and what we're not. And you would have thought the pandemic would have raised that, politicians' thoughts, but I suspect the wave of inflation afterwards has wiped it from their memories.
Exactly. Well, talking about policies, the one I want to just touch on, because you talked about the manufacturing in Australia. Manufacturing in Australia is being squeezed. It's been squeezed for some time. One of the main issues is energy, and of course there was a recent article that suggests that the exports will increase by 60% on demand from Asia. And whilst there is new supply coming on, it will be somewhat downstream. So for the next few years, it's likely that the LNG price will be very high. That translates, of course, to high energy costs in Australia, and that then puts a lot of pressure onto our local manufacturing capability. One of the reasons why, for example, glass making and other things are disappearing. And so we're being more and more made reliant on international sources for these products at a time when we have
prices. And
international prices at a time when this global uncertainty is rising. So we don't really have a good manufacturing plan for Australia that I can see. And when you decouple it from the energy story, then it can never work, can it?
Well, it seems like a hospice plan at the moment. Let's just, gradually usher it out.
Yeah.
What can we do? I mean, look, it's a big deal. Australia is extremely energy rich, one of the biggest exporters of energy. We've got great solar resources. We've got pretty reasonable wind resources. Plenty of coal, plenty of oil, gas. It's like lots of, and for the size of our country, we're not a massive oil producer, but for the size of our country, we're punching above our weight. We certainly produce more than what Australia needs. And so it's a question of why do we end up with, and I won't, I think there's plenty of other ones. We've so much other stuff to talk about, but let's say Australia should have cheap energy, and that should be a benefit for our manufacturing sector. But the policies have driven us in the opposite direction, and I don't see either party with any policies that would bring us back in terms of those. So I think there's that part just seems to be not an issue for either side. Politics.
Cookie made the point, but we have the most expensive property in the world. We should consider exporting them. That's a good point. But then Jason made the point also, and I think this is an important point. If China takes Taiwan, then the US is stuffed, given NVIDIA production and the fact that China is preventing from the day's GPUs. Could they control NVIDIA? And of course, that goes back to the CHIPS Act in the US and trying to bring chip production back into the US, which is sort of happening, but is happening slow.
Yes. Yeah, and NVIDIA is actually out. I think there was an announcement this week about NVIDIA opening, starting on some new factories in the US.
Yes.
So I think it's an interesting thing for them, is that if they build enough in the US, then all of a sudden, would the they're sort of like they've opened up their home country to a bigger security risk when the US goes, okay, we've got pretty much enough chips we can get. I do think there's an element, if like these things are difficult. They're not easy, and if they were easy, China would already have them. And if it was just a matter of copying existing designs, China would already have it. It's really the people that are involved, particularly the senior ones who've got all the experience. I don't think many of those want to stay in Taiwan, and they would be, they would get bucket loads of money to be in any other country. So any of those that can get out, I think would be getting out. I think the other thing is these factories, that they're very delicate. You really do need to, I think they go through, some of these things go through sort of like 200 or 300 individual processes to get to their final steps. And so if you sort of go, if they've got a 99.9% success rate, when you multiply that 99 out 200 times, all of a sudden, you're throwing away half your chips because you just get that compounding effect of just, 1 in 1,000 breaks on, but you got to do it so many times. And so, it doesn't take a a significant amount of damage from a war, and it might be, people as they're leaving, or it might be people like the US deciding to, we'll drop a bomb on something, that would then prevent China from, they'd have to rebuild it, and I don't think they could rebuild a lot of those. So I don't see it as likely that China could take over Taiwan and just step into their shoes and be running it and producing chips at the top end. They'd get a step up, certainly from where they are. They might bridge half the gap, but I think I don't think that's a. I do think there would be sabotage coming out of that from there. But yeah, that's the Taiwan. There's a whole bunch of other things we've left. There's a bunch of loose threads we've left in the trail behind us, Martin. I'm just trying to think what they are.
So, well, let's push forward and then maybe pick up some of them towards the end. So one of the other factors to talk about is inflation, right? So what is the inflation pulse currently doing, and what is it likely to do as a result of some of these changes? Because that, of course, is quite a fundamental question, both for Australia and for the US.
Yeah. So I've got a chart up on inflation, but also actually that reminded me of one of the other threads I left behind was, and it's sort of related, is that the tariffs really will give companies an excuse for greedflation. So, what we saw very much within, say, the US steel industry was that when they've done the analysis of what happened within the US steel industry with the tariffs and the protection for the companies within the US, was that a lot of it just went into higher prices for consumers, and the companies there benefiting. And so, it's, ideally you put some tariffs on and everyone internally competes really hard, and prices eventually, they get better at stuff, and eventually the prices come down. I think the history tends to say, they compete a little bit, but actually they're pretty happy to have a cozy sort of oligopoly and keep prices, just below what might, attract others. And you certainly see within the US, another one is the car industry is very much protected on some of the SUVs and pickup trucks. And what are they great at doing? And what are the prices, significantly higher? SUVs and pickup trucks. And so, I think there's certainly an element of the companies will take advantage, and even companies that aren't involved will be able to say, well, Martin, I'm putting up my prices this year. Unfortunately, those bloody tariffs, we're going to have to put prices up 8% before, and then without most people realizing that actually you guys aren't affected by tariffs at all. You're just using that as an excuse because everyone else has got that excuse.
Because you can, yeah. And of course, just to remind everybody, and there was a very important discussion some years ago where a very senior market analyst made the point that at the end of the day, it's consumers who pay. At the end of the day, it's only consumers who pay, directly or indirectly. The costs of what you buy is where the buck ultimately stops. And, there's lots of overs and unders on the way through, but corporates will still be able to find ways to bolster their profits. And the bottom line is that, well, we pay.
Yeah, that's right. And it's not to say as well, I think as well, that's a very important point, but it's not to say that means that the Chinese companies are going to do just as well. It's more of a question of saying, well, the Chinese companies will do worse out of this, but there's going to be a bunch of other companies all around the place. There'll be some US companies now that have bigger profits. And there'll be some countries in other countries there'll be companies in other countries that will be able to sell into the US that couldn't otherwise sell because the prices were too low that China was importing. So they'll make up bigger margins on that. And so it's not always the person you're targeting at quite often will be damaged by it, but it doesn't mean that the consumers aren't. Consumers are no better off. And we are coming from very low tariffs as well. That's the other thing is globally tariffs are really low. So there's I think there's as with a lot of Trump stuff, there's some grains of truth behind what he's saying. Is targeted tariffs are in areas are useful, but 25% on your two closest trading partners. So it doesn't really.
How to win friends and influence people. I want to go back to inflation, right? You said you had a chart. Yes. If we put that chart up and talk about that.
Have I got that showing? Yeah.
Yeah. Here you go.
Yeah. So this is one from Goldman Sachs from just the other day, and I just thought it was quite a good illustration of really what's going on within Australia. Is there's sort of three. They're just looking at the three different measures you can use, and one of them is the light blue, which is the quarterly CPI from the ABS, and then you just annualize it to give you back a rate. And so, yep, that's been through its big rise. Now it's back down. It's actually right at the bottom of the RBA's range. The red line is the trimmed mean. So this is which one's this one again? is Melbourne Institute.
Melbourne Institute, yes.
Melbourne Institute. So yeah, this is a surveyed one, and so it's a bit of a leading indicator on some of these other ones. And so it rarely sort of matches exactly, but it's a bit more regular and it's been around for a while. And you can see that's sort of, that's out the other side. That's already sort of hit the bottom and out the other side. And then the final line is the year-ended monthly CPI. Now, the monthly CPI doesn't have as many things in as some of these other ones, but there's more, it's more frequent. And so, that's below the, that's into the range. And so, if you look at that chart and you're like, well, what inflation problem? On two of the measures, we're out the bottom and just about to fall. And, on the other measure, it's into the band. And so that's one part of it. The next part is the wages growth. Now, they talk about these wages growth being an issue, and this is their chart. As always, they're always forecasting that wages growth are going to come back, but we're pretty close to 3%, and I just can't see that. I can't see how that's an issue. Like I'd like 3.5% wage growth. The average productivity growth for the last sort of 20 odd years for most countries is sort of around about 1%. It's actually pretty bad in Australia at the moment. So, but 1% is not a bad sort of expectation for productivity growth. And so if you've got 3.5% wage growth and then you've got 1% productivity growth, that sort of leads you at 2.5% inflation. And so, I sort of just don't understand the, and then obviously the way that blue line's falling, they're basically making the assumption that, this thing's going to go L-shaped. It's going to dropping off a cliff, and then all of a sudden it's going to go sideways. So, I think they're overestimating their ability to forecast inflation. So that was one other one. The other ones I wanted to show, and it's stepping through. Trust me, I'll come back to this wages inflation in particular. This is there's some interesting charts from Jared Minak just the other day, and so the first one is just this showing that of the GDP growth, which is the blue line on this chart. Then you've got the red sort of lines or bars, which is how much is the public sector contributing to it. And so for the last year, they've been contributing all of it and more than all of it. So, we're really, the GDP growth is going backwards for the private sector, and it's only the public sector that's sort of keeping us up there. You then jump in and look at, per capita disposable income, and that's going sideways. And sideways if you measure it from 2012. If you measure it from the pandemic, shortly after the pandemic, we're going negative. And the same thing for that real compensation per worker. We've been through this biggest period of negative wage growth that we've seen in forever. It's we're into our third year of real wages going backwards. And where does that lead us? Well, what he's effectively saying then to that point is that if you look at the wage growth versus unemployment rate, they sort of had this scatter plot where you go, okay, if unemployment gets too low, then wages get too high and you got to worry about inflation. And if you break that though into two different series, where were we from 1998 to 2012? You get this one series with the blue line saying, okay, if the unemployment rate gets low, then inflation starts to spike, or wage growth starts to spike. But if you just look at it since 2013, you're on a completely different line, which is way lower, and you're sort of saying at current levels of unemployment, it's just not generating wages. It's not generating wage growth. And we saw from that graph, the one prior, wage growth falling off this cliff. And so the question is, if you're looking at it from that perspective, if all the RBA is worried about is the unemployment rate, then they're looking at the wrong thing. And so Australia could be in a lot weaker position than what you might think. And then this is getting slightly off topic, but it's probably worth just throwing this last chart in. Then and the whole question about this is, why is this happening? And a lot of it is just we're bringing in so many people, and we just don't have the cap. We're not spending on capex. So Australia's capex has been really, really low relative to history, but the number of people we're bringing in is really high. So how do you get labour productivity? Well, you get more equipment per person, and you get more. You spend more in capital expenditure. Whereas we've been doing the opposite. We've been spending less on capital expenditure and bringing more people in. So actually, if you look at our capital to labour ratio, that's actually been falling. And so, not the type of thing you want if you're looking for a productive economy.
Yeah, and it's very interesting. Of course, there was some recent discussions about the public versus private sector growth, the fact that the public sector is bigger than it's been for a long, long time. And there was a big debate about, these workers who may actually be funded by the government, but sort of actually working in the private sector, and how those are counted, right? And there's a big NDS is a good example of those,
NDIS,
right?
Yeah, that's right.
And in fact, NDIS could be bigger than defence spending if we, go on the way we're going.
So I just want to say, I've got my son's, is autistic, but he's quite severely autistic, and so one of my sons, and so I certainly see the NDIS, and I see all the great things that it can do, but I also see that it is out of control in terms of everything's just goes back to, oh no, it's not your money. We'll look at stuff all the time, and people will just go, well, yeah, it's outrageously expensive, but it's not your money. And it's just like, well, no, that's not the point. and I think that's very broadly spread, and it's it's really only just chipping around the edges. And what it's really showing is exactly what we've seen time and time again in Australia, is that if you want to deregulate something and have monopoly providers, you either end up in places where you're trying to deregulate things like the energy sector with these monopoly providers, and you end up with the companies being very productive, but they spend their whole time trying to rip the government off, and that's what they're very productive at doing, is managing to convince the government to pay more than what they should. And we're seeing the same thing in the NDIS, where that we've got a Medicare system and some of our health systems which are the best in the world. Like when you look at the outcomes versus the amount of money spent. Some of the Australian medical system sits right at the top of these. And we've just put this, so we've got all this knowledge. We know how this stuff runs. We know how to do, single payers and bring fees down for all these. And we've just gone and implemented something completely opposite for the NDIS and let the thing run out of control. And so, I think there's I think it's the whole concept of it is fantastic, which is part of the problem. That's your grain of truth. The whole concept is great, and there are some genuine great things it's doing, but you've just opened it up to rorts and to people who are just spending far too much on far too little. And so, and they can always just pull on the heartstrings of like, oh yeah, but it's doing great things for these people. And it's like, yes, it might be doing great things, but it still needs to be at a reasonable cost.
Mm. And it's worth saying, there are always the extremes, and there was an extreme reported recently where a number of people got together and through NDIS bought a house and basically offered accommodation to quite a few people and made quite a lot of money through that process. But the grain of truth at the heart of what the NDS was trying to do is spot on. There are people who need help. The question is it 25% of Australians that are sort of caught within that net, or have we somehow managed to build an elephant when we needed a little bit of a sort of a more jaguar-shaped entity to be able to run it forward?
And also there's elements of saying, okay, look, the public service might be inefficient at certain things, but if their heart's in the right place and they're genuinely trying to provide these services, then you might end up with a better scenario than if you let you let all these you let the free market go, and the free market is very good at working out, hey, the government doesn't really notice if I call it this thing or if I call it that, and here's a grey area, whereas you might have a public servant there who, might be more inefficient, but they're genuinely trying to get the right outcome. And so, but, I think there's, and that's I think where Australia's, it's hard to see where the positives are for the Australian market under all that. So
absolutely.
yes.
Well, just on that, it was interesting that let's put this one up here. This was quite interesting. So the latest results season, this is the Australian story, showed that business profits actually rose. And outside the mining sector, it recorded the single biggest rise in earnings in the 2 years in December, fueling economists' expectations that tomorrow's GDP figures will be picking up. Now, it's quite interesting that when you actually look at it carefully, the quarterly lift was the largest since December 2022. And you wonder what's going on here. Is there something that is, true about this, or is this a bit of a happy aberration as a result of the higher prices that we saw through inflation?
Yeah. The answer is I don't know. I'm not sure. It seems suspicious to me, but I think there's a certain element of it's not a bad environment we're in terms of I think there's a question now of can we of where it's going. I think is probably more interest to me from here, and with the uncertainty, I think Australia certainly being a small economy, very open, we're at risk of trade issues in the trade market. That was actually I'm sorry, that was one thing I wanted to come back to stagflation, because we're talking on the same part.
Yes.
One of the biggest factors, particularly around the LNG one you were talking about in terms of high prices from LNG and how that affected. The big thing for me there is Russia. So does Trump strike a deal with Russia and they come back into the world market in terms of that? Now it seems the way they're going with the Ukraine that's not the case. But we went through some pretty sharp about faces over the last 2 weeks. Who knows what's coming forward in terms of that. But that is a huge wild card in terms of Australia. If we see that Russia re-enters the world economy and is allowed to export gas and do all that type of stuff like that, then maybe we're looking at much lower gas prices. Not because of our own great government policy, but yes, playing the lucky country card once again and relying on others to do the work for us.
Well, it's interesting that some analysts in Europe are forecasting now that gas prices will come down because of they're joining the dots between the US and Russia getting an agreement. Russia then turns on the gas taps and they flow the gas into Europe again, and that could because Germany, of course, is struggling with very high energy prices too, which is why their manufacturing sector is very much being squeezed at the moment, and the tariffs won't help that. And obviously in the UK, gas prices are high too. So
and then what you see is that the US is put on an incredible amount of LNG, and there's more to come. And if that happens, then and it's not at the moment that every bit goes into Europe, but if it doesn't go into Europe, because Europe's now okay, we've got the gas, we've got the pipes turned back on, or certainly some of the pipes. And I think anyway, Europe busily diversifying away and putting on more and more. The amount of green power that's going on there is quite astounding in terms of how fast they're growing all of those. Then those US ships are going to start sailing back into Asia and they bring those prices down.
And I tell you that in the UK, there's an interesting debate going on at the moment, because the proportion of energy coming from gas is actually going down, but the marginal price of electricity is still driven directly off the price of gas. And so there's a big debate about whether that actually is providing effectively false profits for all the other energy providers, electricity providers, as a result of it. And I think there's probably some truth in that. So your point about you pull the lever here and something dropped off the lorry over there is, I think, very true in this one too, right?
Yeah, exactly.
Almost.
But so and I think that's a little bit central to this whole stagflation debate. We spoke a little bit before this about it, but I guess I'm worried about both ends of the extreme on this, and I'm sort of in the middle. I sort of feel like we're less likely to end up there. So I guess what I'm thinking is the two scenarios that seem most likely to me is growth sort of holds up enough, and we've got some pretty strong economies, and we've got lots of lots of productivity gains coming through from some of the AI and some of these, all these other the weight loss drugs. We've seen the obesity rates in the US have leveled off now, and there's all these factors that you can sort of point to in self-driving cars and automation. You can see all these positive effects on productivity, particularly in the US where they're talking about such great productivity. And then you bang on tariffs, and then you have to you see companies starting to add more money to add some greedflation into that, and you get this low growth with higher inflation that we're speaking about before. And as I said, it's sort of this stagflationary environment. And then you look back to Australia and go, well, if the US is in stagflation, but we're all of a sudden getting cheap goods via China, and if Russia re-enters and brings our energy prices down, do we actually end up in this scenario where we've got low growth, but maybe we don't have as much of an inflation problem over here? And then you go, that's one scenario. The second scenario then goes, okay, all the uncertainty and all the chaos that's going on means companies just start going, well, whatever money I was going to spend on CapEx, I just want to wait until I clearly get a clear indication what is happening, and then I'll spend the money. And consumers are all, as we spoke about, a fifth of them are government employees saying, maybe I won't take that expensive holiday this time. Maybe I'll better just save a few pennies just in case I end up with a pink slip. And that sort of flows into the rest of the economy, and you just get a reasonable pullback in the US economy. So Besant was out last night talking about a lot of the things are going to plan, and that a lot of it was they want to have they want to pull back significantly on the fiscal spending from the government and allow the US companies to actually get out and spend money and drive the economy. They don't want the government to be the driver of the economy. They want the private companies to be the driver of the economy. And, sort of the opposite to what we're seeing in Australia. and it's the story's good. The question is the execution. Can you actually genuinely get companies to get out and spend money when they're worried that, they're worried about the legal system in the US seeming to be under a fair bit of attack. They might be worried about tariffs on, tariffs off. They might be worried about just the day-to-day volatility and concerns about what's happening in the public service sector and things like that. And if that's the case, then you won't have to worry about stagflation because a recession will solve that, at least in the short term. And so that's the two ends of the spectrum. And where are we on that? I don't know. And I think we've spoken before about so much is changing that to have one point of view and say, this is exactly where we're going, I know it, I'm just going to set my entire portfolio up for that, I think is dangerous. I think it's more about saying, I want to, come back to those, what are the core tenants, which of the companies I think are making money because they're genuinely in the right sectors and they're going to benefit from this growth, and can I buy them at a good price? And then as they fall, pick them up and move into the next sector as it flips along.
Absolutely. Well, there's a lot to think about there. Now, there was an interesting little comment from, I think, if I can find it, I'm not sure whether I can quickly. From, I think, Confused Cobra saying that there were lots of millionaires in Australia. I have a chart, here we go. I have a chart thing that shows the massive amount of Aussie millionaires, big percent currency difference included. Now, let's be clear. The reason that we've got lots of Aussie millionaires is because our house prices have gone absolutely through the roof. And so there's a really important correlation between wealth in Australia and what's happening with the property market, which takes us quite nicely on to the question of, well, what is going on in the property market? CoreLogic came out and reported that there was a little bit of a bounce back this last month, having seen a mild fall. And I know that you've got some particular thoughts, Damien,
Yes.
on the property market and what's going on. So why don't we just spend a bit of time thinking about that?
Yep. And just before we get onto that one as well, I'm just going to go one quick addendum to what you're saying on the wealth side for Australia.
Yeah.
Is the other one is most other countries have a pension system and a bigger pension system, a safety net, whereas we basically say, no, we're going to take it out of your wages and then you do it at the end. And so, if you're a citizen of one of these countries, the government owes you a certain amount of money because you've worked for so long and you've got your pension thing. how much is that worth? There's probably a couple $100,000 that Australians sort of have explicitly in their super, that if you're a citizen of one of these other countries, you sort of have it, but it's just not, it's sort of off balance sheet, so to speak. They haven't actually said to you, yeah, I'm going to pay you, I'm going to pay you this retirement thing for the rest of your life. And so, yes, I think Australian, the wealth in Australia gets overestimated a little bit by that as well, because it's basically just a flip between governments or personal.
And just on that, and of course, there's this big move now to use the superannuation fund money and invest offshore. There was Chalmers went across to the US and took a whole bunch of super funds and said, hey, look at this amount of money we've got, the second biggest pile in the world or something, and we could invest it in the US, which became a strategic bargaining chip, which I thought was quite interesting. It's not your money, it's superannuation money that individuals have.
Yeah, that's right. Well, I could insert joke about the Labor Party and industry funds and construction going to unions or whatever it is you want there. But I think there's, it's safe to say, look, we're a super fund and we invest a lot of that money in the US. And part of that reason is, I forgot to bring them up I put them up on something I can print out, but I popped it up while I was just in that couple of minutes where you said I was preparing my charts. Was just looking at some of the valuation sides for the Aussie market. Now, I'm going to go to the second year. So there's you can look at all these various measures, but sorry, that's not that chart, Martin.
Oh, okay.
It's just in terms of price to earnings is a pretty common one. Just to say what's your how much is your price versus how much you're earning, and if you go to the sort of second year out of that, you say, okay, what are you going to do next year, and then what about the year after? If you jump through like the big stocks in the US, you go, well, Apple's at 27, so they're pretty high. But Nvidia's at 22 times, Microsoft's at 23, Amazon's at 27, Alphabet's at which is Google, is at 16, Meta is at 22, and actually if you adjust for some of the spending they're doing on that, it gets below 20. Then you go, well, what about CBA? Here's his bank, which is more expensive than any of those guys. It's 25. Well, sorry, not than any of them, but more expensive than most of them. It's a member. If it was a member of the Big Seven, it'd be the third most expensive on its second year out earnings.
And the biggest compared with all the banks globally, right? Even JP Morgan.
Yeah. Oh, absolutely. And you look back at like if you look at the Aussie banks versus international banks, we're trading at like an 80 or 90% premium to them in terms of the values that you get. Like it's just,
but that's because the margins that banks make in Australia are massively higher than banks almost anywhere else. Even now, I mean, they're grizzling about net interest margin compression, et cetera, et cetera. And that's because of the fact that the banking system is protected in Australia. It's a protected species, thanks to the government. It's got effectively a government-backed guarantee directly or indirectly. And, they are all but a monopoly.
Yes. A mega bank, I think, as some people call it. There's the fall between themselves. There's no real difference between them, and they all sort of collude on. But I guess the thing is, though, on that, even if they are earning, not even if they are actually earning some of the highest margins of any bank in the world, as I said. The thing is, if you're going to still pay almost twice what you pay for any other bank,
exactly,
you're basically saying not only are they the highest, but they're going to keep being the highest, and they're going to keep growing faster than every other bank. You'd almost make the opposite argument for some of them to go, well, this bank's only half the margins, and the government wants to protect it a little bit more. Maybe they'll lift themselves up. But it's basically a vote of confidence in the fact that the Aussie banks will keep managing to keep ripping off Australian consumers and cozy up to the government and keep getting deals for it. So yes.
And just on that, this is the CBA chart, so you can see there that it had to come back. That was a result not of their own results, which were strong, but the fact that NAB reported effectively some more adverse results. And in fact, some of the other banks are also talking about margin compression, higher bad debts, et cetera, et cetera. But it's still at 157, which is way above where it should be on any fundamental that I can think about. But the point is, of course, that it's very much supported by the government. And, from an international investor perspective, that government backstop is seen to be effectively quite helpful. And the bad debts are quite low still. They've been able to muddle through the last 2 or 3 years by extending and pretending and giving people effectively more leeway on their mortgage, et cetera, et cetera. And so there is a question as to whether that's going to continue or not. Interestingly, APRA, of course, recently came out and said, no, we are still looking for you to include the student loan schemes on the repayment mechanisms that you use, although the help scheme not, and they're going to publish some stronger guidance on that. But even John Lonsdale at the recent parliamentary committee did admit that the leverage that Australians have to the debt is a big problem. So that was quite interesting.
Yes. Now, interest rates. So
yes,
I guess this is, we're talking about house prices. And I guess the thing I just wanted to highlight for this is, so I run a number of models, which I'll show you some of these, more sort of targeted about saying where can long-term property prices go? In the short term, there's all these short-term pressures, but realistically, what can people afford to pay? And one of the things I keep coming up against, I forgot to label this chart in that time I was going to say one, was that one of the things I keep coming up against is, well, when they lower the standard variable rate, yes, that's important for people who have mortgages, and it does affect the economy. So I don't want to downplay that part. But if I'm talking about somebody who wants to take out a new loan, either a new home investor or somebody rolling out of one property into another one, or buying another investment property, they're sort of when they turn up to the mortgage broker or the bank, they're basically faced with two effective options in Australia. Do I get a standard variable rate, or do I get a 3-year fixed rate? And the 3-year fixed rate is considerably below the standard variable rate. And I sort of try and make it this assumption. So that the red line on this chart is the standard variable, from the RBA, the standard variable rate for, it's a discounted standard variable rate. And then the grey dotted line is the fixed rate interest. And then I make this assumption that, there's some sort of, they don't sort of do a discounted version of that, but there is, you can get discounts on your if you're making more money and a better loan. So I've tried to sort of estimate what is the rate that people are facing when they turn up if you just took the lower of those two. And if you look at it from that perspective, well, actually we had our rate falls sort of mid 2024 when the 3-year rate sort of came down substantially. And even though you're turning up to the bank and you've seen 25 basis points off the standard variable rate, the 3-year rate really hasn't fallen just yet. And so maybe you're not even really, as a new home buyer, you're actually, if you're doing your calculations on what can I afford, maybe the numbers are just the same, because it's like, well, the 3-year rate was this before, that was the number I'm basing it off. And if I have to stretch, well, I couldn't afford that to do it on the variable rate because it's higher than what you can afford. So there's that part of it.
So just on that, just be clear. So the mortgage rate that the banks offer out in the market to individuals, right? There's the headline rate that they actually advertise, and then there's actually the negotiated rate that you actually end up with. And quite often, if you're cautious and careful, you can drive the rate down a little bit. But that is not the same as the cash rate. And and that's because the bank is always thinking about the future trajectory of rates, the yield curve, and how the funding of the mortgage is going to run, because it's a long-term commitment rather than a short-term commitment, right? Now, they quite like fixed rates because it gives them a sort of an anchor, because effectively they're actually outsourcing some of the risk to the person who's actually gone in with a fixed rate, because if the rate moves, then and you decide to sort of renegotiate it, then you can claw back or not. So that's the first point. The other point is that there's a lot of talk at the moment about, we should go for a US 30-year fixed rate, right? And in fact, one of the big investment funds was spruiking this the other day, as you probably saw, right? We got the capacity, we should do this in Australia. And it's interesting, of course, that they're helping Saudi Arabia doing the same thing at the moment. Problem with the fixed rate is you've got to ask the question, who is taking the risk? And what is the effective margin that's actually being factored in? And in fact, it's not necessarily better.
No, well, the US has they've got their sort of government-owned agencies,
Fannie Mae, Freddie Mac,
designed to take the risk on that, because banks, it's hard to find a bunch of people that want to lend money to you for 30 years. So it's and the other thing that does to monetary policy is it all of a sudden takes a lot of the monetary policy out of the hands of the government. The Reserve Bank or Reserve Central Bank of the country.
And that was interesting. Because what happens is if you've got a long-term fixed rate and you think, I've got this 3.5% mortgage from some years ago and now rates are 7%. I'm not going to move. I'll stay in the property that I'm in and I'll actually sit there on the low rate. If I'm a central bank and I want to sort of affect demand and I want to lift interest rates, well, I'm not going to pay more on that fixed rate unless I move, and I'm not going to move. So actually it has an economic consequence on the housing sector, but not necessarily one directly on the influencing rate. Whereas in Australia, of course, because of the massive leverage via the variable rate that most people still have at the moment in Australia, it means that the RBA's moving of levers has a more direct impact on more households. So that's something to understand the difference between the US and the UK and the Australian market. The UK's moved closer to the US. New Zealand has moved closer to the US with more fixed rates, although not long term. But it does show you that Australia is probably more exposed to interest rate movements than almost any other country.
Yeah. So the US in particular, when they're changing rates, are really affecting new home buyers, and all the existing ones are like, I don't care. You can do whatever you want. I'm on a fixed rate. So where does that leave us? And I'm going to show the Sydney charts for these. They're pretty similar, and the other ones are available. We can sort of, if you subscribe to our newsletter, you'll get these coming through on those. So what it's showing for Sydney is if you look at the mortgage payment versus the median wage in Sydney, sort of oscillates between sort of 40% on the downside, and we peaked over 100% on the upside, and currently we're at 93. So the longer term average for this is somewhere around sort of 50, 60% in terms of what's the median mortgage payment versus the median wage. And so we're at the 96th percentile. We've basically never been higher. Even at 17% interest rates back in the 80s, we weren't this high for Sydney houses. If you look at that, possibly, this is more, there is more dual income families, and maybe that's why we're seeing that, but maybe the overall rate could be higher than what it used to be, but it's still from 90%, if you came back to 60%, you got to cut 30% off that. Now you can either get that through wage growth, or you can get through that through mortgage payments falling. And so, that's, or house prices, I guess, could fall. That's, that seems outrageous, but one of those three is going to get you back there. Then you can go through, that's one measure, which is basically, look, people have to be able to afford, in the long term, people have to be able to afford to buy the median houses on the median wages. Then you can look at the mortgage payments versus rent. Now in Sydney, that oscillates somewhere between a little bit under 100% to, I think we sort of peaked out at maybe 220, and we're at 200% at the moment. And what I mean by that is, if for Sydney houses, if the cost of having a mortgage falls below the cost of rent, so it falls below 100%, you tend to see the prices then starting to rise. The average seems to be somewhere around about that 150%. Again, we're just miles above where that is in the long term. I think I'll actually just talk about those ones. I do throw in the property price to the median wage, which sort of matters for getting into the house. And then also you can do some investment measures. So those were the affordability measures. And you can look at the investment measures of gross yield, which is, at its 4th percentile, so as low as it's ever been. And then you could look at the net yield less the mortgage rate. And that's sort of basically sitting dead in the center of where it's been over the past. So that's sort of a big picture of it. And then you go, where are we sitting in terms of those, for all these other different cities? And you can run through those ones. But, Sydney at 202 on the mortgage payment to rent. Most of the others sort of 150, 160% for houses, and then falling back to sort of lower levels. And so other cities are cheaper, units are cheaper, but what really matters, I think, for these is where they are versus historical levels. And that's what I've got on this next chart, which is then showing as a percentile, how close are you to 100% is as expensive as it's ever been, and 0 is as cheap as it's ever been. So on that basis, it doesn't matter what you look at for houses; they're all really expensive, and even places like Adelaide that might look cheaper than say Sydney or Melbourne, but they're actually at the highest they've ever been on those bases. The net yield versus interest rate is about average, to be honest, on those, and a little bit cheap for units. Units look a fair bit cheaper. You're expensive, but Melbourne units, for example, aren't that far away from what they've been in. They're pretty close to average actually if you look at Melbourne units. So I guess the question for these is saying, then on our website you can jump on and play around with some of those ones, but you can have a look and say, okay, what do I expect for interest rates? What do I expect for inflation? And what does that mean for these, and how much money you make out of it? So largely speaking, it tells you what you think. But I think it's important though that because we had such strong rental growth, and you've seen some property price falls, that on one side you go, well, actually maybe that means things are looking a lot better because my rent growth has been great and property prices have come down. Maybe the equation is starting to look reasonable, and the answer is no. It's more reasonable than it was 6 months ago or 12 months ago, but it's still if you look over the last 50 years, it's still right at the extremes.
And that's consistent with my analysis. And in fact, next week, I'll be covering that off in more detail. There are still lots of households with more than 50% of their net disposable income going on to pay the mortgage or indeed to pay the rent. And that's as high as it's been. So, we have a problem with affordability. And the small rate cut that we saw is not going to have a significant impact. It's unlikely from the RBA's point of view we're going to see a lot more rate cuts over the next year or so. So the expectation is that household pressure is still going to be there, but people are almost forced to play this game because they still want somewhere to live. And so what they're doing is rebalancing effectively their expenditure, and so they're spending less on other things and spending more on housing because it's horribly expensive. They know it's horribly expensive, but they don't feel they've got a choice.
Yeah, and the rent part is the interesting one as well. For if you look at the long-term histories of rent growth, it's in terms of real numbers, the real growth is pretty close to zero. Like basically rent grows pretty much at inflation, at the rate of inflation, maybe a little bit above, but it's very close to zero. We've been running at these record levels of 7, 8, 9%. You just can't run rents at that rate and without sort of running into the problems of social unrest. And the young people who are obviously seeing bigger and bigger parts, and then they have to start sharing more houses and more people in more rooms. And I think that's a recipe for getting kicked out of government.
Yeah, and it's just worth reflecting on two factors there. This idea of the social unrest, intergenerationally speaking. So there are youngsters looking at people who are, up the generations, who are sitting on massive paper profits and in big houses, and they feel that it's an unequal struggle now. The other side of it, of course, is where you actually have high levels of financial pressure on people. The first needle that moves is actually crime rates. And I've been doing a bit of work recently on the rise of crime rates in some of these highly stressed areas that I've been looking at. The second point is there's quite a high correlation between disruptions of relationships and high financial stress. So if you look carefully at things like divorce rates and relationship breakdowns, as well as health issues, they're all higher in areas of high financial pressure. So there are not just financial consequences, but there are social consequences of these policies that have been running out for the last 20 to 30 years. And a lot of that is not really, I think, being covered by the mainstream very well.
No, and I mean, and one that I know Leith, you see, he jumps on quite often is this whole, something like the tobacco, where it's like, look, let's just keep upping the rates on tobacco. We've created a black market. There was never a black market in this, 20, 30 years ago, because there just wasn't enough money in it. But you up it's this bit about social policy and how do you design things. Yeah, okay, I want people to stop smoking, but if I charge everyone $1 million a cigarette, well, nobody's going to pay $1 million a cigarette. They're all going to get it on the black market somewhere for much cheaper. Yeah. And so there's this push-pull between saying, and I'm surprised, just one more example of Australian policy being run badly, saying, well, when you start seeing everyone being firebombing each other and all these things popping up, is saying, well, maybe it's our fault. Maybe we should just drop the excise back a bit and take a lower crime rate. Anyway.
Well, it's relevant because another unintended consequence, of course, is the declining birth rate. So one of the reasons why the Australian birth rate is declining is that people are getting hitched later, and they're finding it more difficult to be able to afford anywhere to live, and therefore can't start a family, and therefore we are becoming more and more reliant on the migration rather than actually building families locally. All these things are connected, and what I get so frustrated about is nobody seems to want to join the dots.
No, that's right. And it's I think there's yes, we're facing numerous problems, and we have a very expensive stock market in Australia, and so it's one more reason that we should be getting our money offshore.
Yes, well, interesting that. Now, as we come towards the end of the show, just one other topic briefly, gold. We need to talk about gold, I think.
Yes.
So,
and Bitcoin and Solana.
Yeah, Bitcoin
the new government, the new reserve in the US. Yeah.
So briefly on gold, let's just push that one.
Let's
get that one.
My chart, not yours.
Yeah,
yep.
I've got too many buttons here. So gold's dropped down, went back up again. Now, of course, there's an interesting question about gold being moved physically from London to the US, and that was ahead of some of the tariffs and logistical problems. A lot of people were saying, it shows you there's not enough supply. Probably more to do with the fact that the truth is that it just took a lot longer, because the gold has to be melted down in Switzerland or somewhere like that, because in the US, the standard size of the gold bars are different from ones in London. Right, so it's a non-trivial task. So I did a show of that the other day, and looking specifically at what the Gold Council has been saying. So they're arguing that it's not really a shortage of supply; it's a logistical problem. And actually, some of the different margins that went up to about 5% between the futures and the physical gold price, because people were actually finding it difficult to be able to actually meet requirements. That's come back down now. So maybe that's gone away, but gold is definitely seen in this time of uncertainty as one safe haven. And then, as you mentioned, Bitcoin, of course, has been gyrating all over the place recently. We hit 108 at one stage, or close to 108. Then it dropped back down towards 80. But this is to do with the Trump policy of using crypto as effectively a Federal Reserve. Not sure whether that's a good plan or a bad plan, but it's quite interesting.
Well, and yeah, look, you don't want to have conspiracies everywhere, but is it a market manipulation? Is it who knows? Like, it's a wild west of that. There seems to be a lot of his advisors are pretty involved in in that crypto market. And if it's a question of can you pop out a quick announcement on this, and if we follow through, we follow through. Who knows? Will they? Is this just a thought balloon that popped up, and once the price propped and whoever needed to get out got out, they comes back again, or is it something he's genuine about and wants to? Who knows? And so I think that's part of the I think if you're going to buy those cryptocurrencies, they're volatile already before you even started, and now you could have Trump's full backing, and he could decide that actually, no, you know what, he hates whatever one you're in, but he loves Trump coin and Melania coin or whatever it is, and they're the ones that are going to be part of the reserve. And so, it's a tough. It is tough in terms of that part, and you're speculating, pure speculation and gambling on what he's going to do, and he probably doesn't know what he's going to do on that front.
And it's interesting. The head of ASIC recently gave evidence and said, I don't think a lot of people understand just how speculative these crypto assets are. Though interesting, of course, in the US, they had Gensler previously at the SEC, who was quite negative. And then, of course, he's been replaced with a whole proactive group of people around Trump who actually are very positive towards the Bitcoin and the crypto world, and are saying that the US want to see the US leading the way. So what I have always believed is, if you want to speculate, fine, but don't use it as part of your core wealth building strategy, because the uncertainties are off the scale.
Yep, absolutely. And it has turned into a very leveraged play on other assets. And so what I mean by that is that, look, when the stock market goes up 10%, it goes up 20, and when the stock market falls 10, it goes down 30, or whatever. And so I think there's you just need to keep that in mind, is that you're getting a supercharged view on whatever that's whichever way that's going to go. But the message as well is, I certainly can't decide. I certainly can't predict what Trump is going to do. I don't think Trump himself can predict what he's going to do. And if you want to gamble on that, then have at it. But I think there's other places, better ways to make your money.
Absolutely. Well, talking about ways to make your money, what we, I think, have covered is that there is a huge amount of uncertainty out there at the moment, that this is more than just noise. There are important decisions to be taken, but again, not to overreact. And I guess something like the fund processes that you have there, with the transparency and visibility and the options, give people quite a lot of flexibility to be able to react to it. Or if they're too busy, then they can just say, well, you look after it for me, don't worry about it. So any closing thoughts in terms of, how to react and how not to react at the moment?
Yeah, I think that the main thing with all of these is you need to have a plan for what you want to do if markets do take a tumble. And so, that plan can change. And I think at the moment, it's very much based around the fundamentals and what we're seeing in terms of fundamentals. Does what Trump's doing, does it damage the economy enough that you fall into a negative spiral, or is it just going to slow things down and raise interest rates, and you might run into some risks of stagflation? There's that problem, or does it end up in this sort of happy medium somewhere between the two, where you've got enough growth but not enough painful parts? So I think our view at the start was that you'd end up in this something that was, hopefully that it was a lot of sort of smoke and mirrors and a lot of noise about smaller events, but actually the end impact on people was pretty minor. Was sort of our initial take. It does seem to be more serious than that, and it seems to be, I think the chopping and changing is certainly bigger than what we thought. I think the hope was that some of the, or Besant in particular, would sort of rein in some of his more extreme examples, and that you would see the tariffs, lots of noise about it, but in the end, not a lot of push through in the end, or certainly a staged version. Who knows? It's certainly at the moment it looks like that's not the case. And so, I think there's enough to say, look, let's take some risk off the table, and that's what we've done. I think if it continues going in this direction, we'll just keep taking more risk off the table. We'd never go back to zero. We'd fall a little bit. And then with a view that at some point, though, with a lot of that, there's fundamentals underlying the economy. And, if you did get a recession, say, in the US, and you saw things fall back a bit, there's still a lot of fundamentals that actually look quite good over that sort of medium term. And so there'll be a question about when, I'd love to buy it at much cheaper rates. And if we see that through the sort of chaos that's coming, then you want to make sure you know what you're going to buy and when you're going to buy it, because at those times when markets start falling, everyone, all you'll read in the newspapers is get out. You'll never be able to get anything. It'll be terrible. It's going to for the rest of your life, markets will be low, but there'll be a point where it's actually, no, this is a reasonable price to be paying for these things. We are still seeing pretty reasonable growth coming out of those, some of the AI. That really hasn't slowed up much. We're still seeing some reasonable growth. Areas of the defense sector. There's some companies in Europe that have got, that are looking better than what they've looked for some time. Depending upon what happens with energy prices, there's going to be winners and losers in various countries. Like it's a matter of saying, look, I've got those lined up so that I know that if Russia re-enters and you get some sort of peace deal, what are the companies I want to own in my portfolio that are probably European and suddenly going to benefit from much lower prices after the huge prices. If that doesn't happen and we get the opposite, that it ends up in the US siding with Russia and China, against the Ukraine, what does that mean? What are the companies that are benefiting? What are the ones that are going to suffer? It's just about game playing it before it happens, so you're not sort of sitting there, in the maelstrom trying to work out what to do. It's like, no, these are the ones I want in my portfolio. And these are the ones I need to get out of those scenarios.
Yeah, I think having a plan is the critical message from today. And Damien, I want to say thank you very much for sharing your thoughts as always. Look forward to doing it again in a month's time, by which another earthquake or two will have probably followed.
That's right. We're talking about the opposite.
Who knows? But I guess that's the object of having these conversations. Thank you very much indeed. I've put links and things below if people want to find out more info about Nucleus Wealth and what the Wealth funds. People are actually using that facility, and it's, I think, quite relevant and appropriate given what we're seeing at the moment. So thank you very much. I'm going to take you offline now, and I'll close the show. See you later. Bye. There you go. Well, I hope you enjoyed that. I think we covered quite a lot of ground tonight, and Damien, of course, always great value. I'll look forward to catching up again with him next month. Next week, I'm going to do a deep dive on the modelling that I did, specifically on the scenarios with regard to the property market, and also look at the latest financial stress down at the postcode level. So that'll be what I'll be doing next week. And I think the following week, I've got Spacious, Phil coming back on from Spacious to talk about his analysis of what's happened to property prices. So that'll be interesting in 2 weeks' time. Thank you very much for spending some time with us this evening. The dogs are still here. They've been quiet, which is nice, and there'll be time for their walk and lunch, etc. now. So thank you very much for spending time with us this evening. Take care. If you're up and around Brisbane, keep yourself safe over the next few days with all the storms and everything there. And I'll look forward to seeing you next week, and of course on the daily recorded shows. This is Martin North from Digital Finance Analytics signing off. See ya.